Today we're going to look at the producer price index data that we got this morning about 7:30 Chicago time, 8:30 Eastern. It was hotter than expected, and I'll give you the reasons, the numbers that jumped off the page when we break down the tables. First, I'll give you the actual numbers that came in. First, headline month over month PPI up 0.9%. That's higher than last month. That was unchanged. That's higher than the expectations. Year over year, headline PPI, 3.3%. Higher than 2.3 last month, higher than 2.6, which was the consensus. Core, again, up 0.9%, up from unchanged and higher than the 0.2 expected. Year over year core, 3.7%, much higher than 2.6%. Ex-food and energy up 0.6 month over month. Year over year, ex-food and energy trade services, 2.8% higher. Now, where did we see the numbers? What makes up these big numbers? Final demand for services were up 1.1%, the highest level since March of 22. An interesting tidbit. What was up 2%? Margins on final demand services, margins. So theirs throws a little bit of a wrench into that, as the margins, the difference between where wholesalers buy them to where they sell them was increasing, raising prices, not necessarily what they're buying, but what they're selling. Their margins went up, of all things. Final demand goods was up 0.7. That's the largest since just January, not very long ago. But of that, final demand food was up 1.4%. 1.4%. That's interesting in itself. But here's the thing. Diesel fuel oil index up 11.8%. That might be why crude oil's higher this morning. That explains why rates are firm this morning. Why is the market not reacting the way you may think? Because of the four things that look at inflation in a month. Wages out of non-farm payrolls, PCE out of income and outlays, and CPI. PPI is the fourth, and it's the distant fourth. So the reaction by the market, which you may think is a bit muted, is because this number doesn't always show up in the CPI data, something you have to just be cognizant of.